No, I was saying that the government shares a lack of confidence with people. We had bank base rate of 0.5%, we've got inflation at 5%. That ratio of negative real interest rates is the largest in modern British history. So my hunch is that the underlying agenda here is fundamentally about recapitalisation of the banking system rather than actually wanting to encourage people to save. And as Harriet's already pointed out, the sensible thing to do is to kill debt, particularly consumer debt. Certainly don't think about going anywhere near a bank, which is contrary to the government's objective. It's trying to rake in as many ultra-cheap deposits as possible. But this, of course, gives rise to some ludicrous arbitrage opportunities, which I've been exploiting, which is my background in arbitrage. I can borrow through security on my home at 1.5%. So I borrowed £250,000 last week. I put it into the National Grid bond. Index linked, absolutely key point, yes, there aren't many of them around, and that's currently paying the equivalent of 6.25%. So there are opportunities, but the fundamental landscape is dominated by a lack of confidence. And even within the government, we have what I'm only characterised as a push-me-pull-you character. If you go and talk to the DWP, as I occasionally do, of course they want lashings of savings. If you go and talk to the Treasury, that is the last thing they want. They want you to go and spend it so they can rake in lots of VAT. And therefore, it's very difficult for the government to come up with a consistent set of policies that's going to remotely encourage people to save. As an aside, and I must touch on this because Harriet raised it, the net default fund strategy, absolutely potty. If you want to encourage people to save by luring them into a low-risk default fund strategy in the early years, and not to mention that you whip 1.8% away from what they put in, they are almost certain, over the first 10 years, to erode about 30% of their capital. And I am making an assumption here that we're going to have negative real interest rates for quite a long time. So in 10 years' time, I can envisage a situation where we have the crucial target audience that Nest is looking at, the low to middle income, turning around and saying, what the hell was that all about? I think it will turn into one of the great mis-selling scandals. The Nest default fund strategy has to be shredded, and we need to start again, and we need to educate people into the concept of risk and return, rather than dominating this with the stench of politics, which is about minimising the opt-out rate, and therefore let's be ultra-cautious. It's going to be a massive own goal. I'm then going to move on to things a little bit more contentious. The starting point is, if one wants to be constructive here, is actually to raise the basic state pension above the means-tested threshold, as has been widely discussed, catalysed by probably, certainly I've written about it a few years ago from Steve Webb and the great and good in this area, such as Frank Field. Once we have established a base rock of certainty of income in retirement, it then creates some confidence to save. It does a number of other things as well. We get rid of S2P, we simplify, and that's part of the problem of the whole savings landscape. As an aside, it would be a perfect tactic to pull out of the public sector pensions negotiations, as I wish the government would do. How do we get onto that subject? And raise basic state pension, then go back to the unions and say, right, we have addressed your legitimate concerns about pensioner poverty. We're now going to talk about moving to DC. But let's not forget that we're in a DB desert here, so the savings landscape is dominated by the yearning for certainty, and unfortunately the price of certainty is going up. The affordability point, we need to talk a little bit about incentives. Tax relief, I'm afraid I'm a bête noire on tax relief. I would get rid of it all. Certainly the higher rate of tax relief should be instantly done away with. I think this is going to be a benchmark policy for Labour, which of course I now agree with, so I'm not quite sure whether I'm in the right conference anymore. But the key point about tax relief is as follows. What is its purpose? We spend about $30 billion a year on upfront tax relief as an incentive. Why don't we strip out all the middlemen, and that means the industry, and add that $30 billion a year to the $50 billion that we you spend on a basic state pension and increase that by 60%. I think that would do more to address pensioner poverty and encourage people to save than any other step. But I shall leave that one for you. There's lots of then sort of minor actions the government could be doing, yes, issuing index-linked bonds, but then why on earth would it want it? They're expensive. Inflation is at 5. Why on earth would you be issuing index-linked bonds when what you're trying to do is recapitalise the banking system? It's not in the interests of the government to do so, and therefore the news about the national savings thing is absolutely no surprise. What the government could be doing is issuing bonds linked to GDP, which gives you a relatively stable benchmark against which to measure asset performance. And it's also, of course, correlated to the performance of the economy. So if GDP were wonderfully or miraculously to accelerate, then asset returns would rise and the government's ability to service those bonds would rise with it. Things like infrastructural bonds clearly is something we need to be looking at. ISAs, as some of you probably know, I'm a fervent fan of ISAs. I think we should do away with the P word altogether. I think pensions should be consigned to the dustbin of history. They mean absolutely nothing to Generation Y. What is the point in putting money aside in a pension when you're 20, 30 or even 40 years old and not owning a home for some distant, uncertain return? So let's sort of fast forward and do away with pensions. That's a slightly contentious issue, I agree, but it's something I believe will happen. Another area to capitalise saving is around risk sharing. The current stance of the government is niet. For some fairly reasonable reasons, but I know that Steve Webb and others are now revisiting this, it is clearly much cheaper to hedge risk as on a collective basis than it is as an individual. So I think we will need to be accommodating on risk sharing in a way that currently we are not. Tim, stop because I've got loads of lists of things to say. Employers, absolutely crucial in this equation. Part of the 30 billion a year that we spend on tax relief, I think, should be used, I'm suggesting 5 billion, Harriet, to openly bribe employers to encourage greater workforce engagement and saving. Measured against a number of yardsticks to do with what proportion of the population or workforce is not opted out of Nest, for example. 5 billion a year would be a fantastic investment. Purchasing the distribution capability of the employers. One other area that I think will make a big difference is I'm interested in generational trickle-down of wealth. And so the suggestion that I've been banging on for a while, so I'll have another go, is that when we bequeath assets to whoever, if those assets go into people's pension pots, they should be free of all inheritance tax. So we capitalise a generational trickle-down of wealth within a pensions architecture. And I think that would start to engage family conversations in a much greater way. It would prevent wealth going down to generations to be frittered away because it would be within a pensions framework and so on. I'm going to stick forward a few things. I'd love to, by the way, arrest the 1.8% subscription charge, get rid of it. If you ever want to erect a barrier to engagement, that's one way of doing it. The government should swallow the costs and think of it as an investment. The regulator, finally, is that fair, finally? The regulator's up the wrong tree. Essentially, the regulators are, and Philip's lady works for the FSAs, and she's very good. The regulator's perspective is all about essentially prudential and caution. I would like to see the regulator shred all the books and step back and say, what is it that we would be doing and thinking about if we shared a common purpose with a man in the street? What would we actually be doing and talking about? And I think one of the things the regulator could be doing, much more proactively, is to be driving forward, quite ruthlessly, an efficiency agenda within the industry. So attacking the whole question of transparency, everything will cost right should be totally transparent. The question of how do we encourage the industry to align its interests with the man in the street when so patently doesn't do so. The whole question of why it can be pretty ineffective governorship, because governance is at the root of a lot of encouraging people to save. If trustees were really hard on the industry and actually behaved as the principles that they really are, then I think that would take us a few steps further forward to really attacking the industry's cost base. I'm going to stop